Welcome everybody back to the A to Z of property strategies, and today we've got DJ David Clouter hot off the discs, here still with his headphones on, specially for you, and he's either joining us or he's listening to some hot tunes in there, and I'm not going to tell you which it is. So yeah, he's rocking it again just like he always does. So we're back on the A to Z of property strategies, and we're in the eyes, if I don't get that wrong. Do the eyes have it, David? Sounds like a politician.
The eyes certainly have it, Andrew, and we're going to kick off with some difficult ones. So, being a bit of a coward, I'm going to sort of pass them your way as the expert on finance and such things. And I thought if it's all right with you, we could start with interest rate swaps and possibly more important hedging.
Okay, that's a bit of a nice side pass, isn't it? Well, I'll tell you what, I'm just going to look over and enjoy the view over the Grand Canyon as we sort of sail by in our helicopter. This is really quite cool, mate. So, interest rate swaps, interest rate hedging, great topic, really good. Now, this can be approached from many different angles. Banks do this very frequently. If you're looking for a fixed rate mortgage, banks themselves are risk averse and they do not take risks. So the way a bank does this is they will borrow money off somebody on a fixed rate and then lay that off to you with their margin on top. So that's one way of looking at it. And typically a hedge fund would provide the money into the bank on a fixed rate and the bank would lend it out to you. Now, we're looking at this as a property strategy. So how's that work in property? Well, if you're a big portfolio landlord, what you can often do is lay off between yourself and somebody else on a swap. Now, the way that works is you have got a portfolio, and say your portfolio's worth 10, 15 million. So I did say a portfolio landlord, didn't I? And your portfolio is 10 to 15 million pound. What you can do is find somebody else who's got a 10 to 15 million pound liability on their side of the equation as well, where they've borrowed money. Now, it could be you've borrowed on fixed rate, but you're predicting interest rates drop. They've borrowed on variable rate, and they're predicting interest rates will rise, so they want to fix. Or it could be that they're a business, and part of the objectives of the managers of the business is to keep within budget. So by swapping your fixed rate for their variable rate loan that they've got, they effectively agree to meet their budget by using the fix. And you get the benefit of the variable. Now, let's wind these numbers down to keep them simple. The interest rate that you're on is 5%. And what you do is you agree to swap £1 million of your portfolio loan for £1 million of their variable rate loan. Now, their variable rate loan is on 4% LIBOR. LIBOR is 4%, and they swap you on a variable rate margin of 1% above LIBOR. Therefore, you're both at 5% at the start. So there's no gain, there's no loss. Where the gain and the loss comes is if LIBOR moves. Now, during the course of the year, LIBOR moves to 4.75%. At the end of the year, because you've agreed a 12-month term, and it's important, there's two key criteria in here, the terms and the period. The period, we will do 12 months to keep things simple. The terms are what the rates are going to be that you agree to swap and any fees that you might agree to share between you, but generally speaking, you do it at parity unless there's a broker in the middle. So we've agreed to swap $1 million. I've got a 5% fix. They have 4% plus 1 over LIBOR as their rate. So you're both at 5% at the start. LIBOR moves up to 4.75, which basically means I have been hit with an increase in cost and they've still got their fix. I, at the end of the year, pay them £50,000. At the end of the year, they pay me, the other way around, they pay me £57,500. So the difference is £7,500 as a result of that swap. So I've ended up worse off and they've ended up better off as a result. So their budget, they fixed that, but they also got a bonus of £7,500. Now, the same could happen. David, my very good friend, he believes in fixed rates. He loves fixed rates. I'm a gambler. I like variables. But one of his fixed rates has come to an end and he's on a variable. I took a gamble and went for a fixed rate. We've both got a £100,000 mortgage. Unfortunately, he wants to get a fix, and the market conditions at the moment mean he's not getting any good fixed rate offers. So I agreed to swap interest rates on an investor to investor level. So that simplistically, drilling down from the £1 million down to the £100,000 mortgage figure, is your interest rate swap, or hedging the interest rate one against the other. So I've given you a rather complicated, convoluted answer there, but I hope I've simplified it enough for you to be able to understand it. And if you need to know more, drop some comments in the comments box below and we'll answer those for you. Or if you want to work through a scenario for yourself in your own portfolio, David and I can help you again with that. So
Happy
David,
to do so.
Is that helpful?
And, yeah, in a sort of super simple way, assuming that suppose I don't even have a good friend like you that I can do anything with, and I'm sitting here, thinking of buying a few properties, and I'm not really sure. I'm not really sure at the moment, whether interest rates are going to go up or down. Now, obviously, it's hugely beneficial for me if I think they're going to go up to have a fixed rate. It's hugely beneficial for me if I think they're going to go down to have a variable rate. So as I'm taking out my mortgage products, say 4 or 5 of these, I might decide actually to ask the bank if half of these could be fixed and half of these could be variable. And then, in a sense, either way I lose a bit, but either way I gain a bit. But I've certainly reduced my potential future losses.
No, you certainly have, and that's what it's all about. It's about working out your cash flow, and do you want certainty, or are you a bit of a gambler and prepared to take a risk? A lot of people work on the premise that the variable rate works for them. Some people prefer the fixed rate. If you'd have gone back 10 years in your time machine, back to sort of 2008 to 2012, when interest rates dropped down to 0.5%, 0.25%, you'd have been forecasting rates could only rise. We're now at 0.1%. You got the gamble wrong, so you've actually paid more. There's no right answer in this. Very few people can accurately predict where the market is going. But it's a good tool to use.
Absolutely. Now, the next one on our list concerns really the way to talk about things to investors who are used to investing in different asset classes. Say they might be used to investing in copper futures or forex or equities or bonds or something like this, and then they think about property and they come to you saying, can we do something together? It's a way of talking their language, isn't it? And this is called internal rate of return.
I feel a side pass coming here again. Are you expecting me to answer this, being the accountant in the room?
As the knowledgeable one. Sorry, Andrew.
Well, as they go, my favourite sport's rugby. I've got the side pass again. Yeah, I mean, different people invest in different asset classes. Could be gold, could be copper, could be coffee. And what they do is that they generally work their investments on a series of convoluted spreadsheets. And there's a couple of things that they do. They turn around to you and they say, hey, I'd like to lend you some money, let's say £100,000, and I want to lend it you for 10 years. You sit there and go, yeah, that's a pretty good deal for me. I'm happy with £100,000 for 10 years. Now, these guys are a bit geeky on their spreadsheets, and there's a thing called inflation. Now, with inflation, it basically erodes the value of the pound each year. So, last year, a price of a loaf of bread was, for argument's sake, £1. This year it's now £1.05. So inflation has meant, of 5%, has meant that your loaf of bread costs you more, or your pound doesn't buy as much. So internal rate return is looking forwards into the future and calculating what return they will get over a 10-year window, effectively discounted to today's value, and it's expressed as a percentage. Now, another way of looking at this, and we'll do this under ends, is net present value. That expresses it in a monetary amount. So they're very different, a net present value and an internal rate return. The one is bringing the value back to today and telling you in percentage terms. The other one's giving you a monetary amount, the cash that lands in your bank account. So if I was investing in gold and I was getting a 5% return, and David approached me and said, "Hey, my good friend Andrew, I'd like to borrow some money from you and I'd like to offer you an interest rate on that money." I'd be sitting there and going, "So what's that interest rate that you're going to offer me, David?" And David turns around and says, "Oh, I can give you 6.5%. Face value, 5% from gold, 6.5% from David. David sounds like a winner." What's the terms, David? Well, it's over 10 years. So we now start to drop those numbers into a spreadsheet. We put £100,000, say being the amount borrowed. We discount that £100,000 by whatever the forecast inflation rate is over each of the years for the 10 years. And then we add all of those up simplistically. There is a function called equals IRR brackets, which you put into Excel, but that just makes it simple and boring and geeky to share with you that way. But what we do is we discount that cash flow. Now, when you've discounted the 10 years worth of interest that David is earning at 6.5% from me, £6,500 a year, by the time year 10 comes, using the loaf of bread, I'd originally be able to buy 6,500 loaves of bread today, but in 10 years' time, I could probably only buy 4,000 loaves of bread. So it's equivalent to a 4% interest rate, simplistically. So what the internal rate of return does is calculates the weighted average over that term for you and expresses as a percentage. And it might come out at 4.8%. So the city investor goes, "I'll stick with gold." Or the city investor might go, "It's 5.2%. You're a better deal, David, even though on the face of it, it looks like you're paying 6.5%. And similarly for you as the investor, if you're offering somebody 6.5% for 10 years, actually as time goes by, the value of that interest goes down. So that's my very simplistic take on it. David, would you like to add anything to that?
There's very little I can add to such an impeccable work of genius, Andrew. I think you've totally summarised the situation. It's exactly what I had in mind, and loads more besides.
Superb. Well, I think, given that we're on ice and I'm doing the first two, the next one's yours.
Okay, that sounds fair. There are two really which go together. The first of which is investing for cash flow. There are two ways to invest in property. You might want all that money in your pocket every month, or you might want to have a huge amount of assets sitting there in the background. And the thing is to get the balance right, really. And traditionally, this has hinged very much on the North-South divide, whereby because properties in the north of England for many, many years haven't gone up as fast as properties in the south of England, rents kind of tend to go up ballpark all around the country, more or less the same. But the values of these properties vary tremendously. When I started investing in property in London in 1982, it was the best property I ever got, and we could go into this another time. I was getting an 18% gross yield on this property, and I did a magazine article once for, I think it's YPN magazine, and the editor said, "You couldn't have done that." So I explained the numbers, and he goes, "Yeah, okay, you did," and that was an extreme case, but certainly sort of 14, 15% was kind of the norm. And those were great returns in London, where the property is subsequently a £27,000 flat that I bought, 27,750, so nearly £28,000. In today's money, worth 450 to 500,000. So the capital growth was a sort of bonus, but the cash flow part was the part that enabled me to reinvest some of that money, and to buy more properties. It was very important. It also enabled me to buy my weekly groceries. So cash flow is very important for a business. And if we're looking at property as a business, which it kind of is, let's face it, if your cash flow falls a bit short, then you're kind of really in trouble. And my dad used to be an accountant as well, and he used to quote. I'm surrounded by him, and my dad used to quote. I was going to say Charles Dickens is Mr. Micawber, which said something to the effect that expenditure 20 shillings, income 19 shillings and 11 pence halfpenny, disaster. Expenditure 26 shillings, income 20 shillings and a halfpenny, magic. And so it is, because you can't go on subsidising your business with losses forever. So we always need to be sure that the cash that's coming in meets our liabilities, which in the case of landlords, the principal one of which I suppose will be the mortgage repayments, and lots of other things as well, like taking account of voids and taking account of various other expenses, insurance and so forth that we have. So having a strong cash flow is really, really, really good. And from a personal point of view, and hazarding a guess at the future, at the time where in some of the London boroughs now, the retail price of a property is 20 times people's gross annual earnings. Is it realistic to think that in 10 years' time, with this thing of things doubling, that in 20 years' time it will be 40 times people's annual incomes and 80 times? I think there has to come a point where there's some kind of price correction. So that means that in terms of this capital growth thing, there's an element of gambling with it, because if I go out and I buy some M&G or Fidelity and other companies available, unit trusts or whatever, there's always something in the small print that to say that the past performance is no guarantee of future growth. And I think they should add this to properties now as well, because we can't be sure of that capital growth going on. So. And in a sense, we southern investors have tolerated the pain of our yields going down and our cash flow being really squeezed to the point where now it might be 1.5%. It might be 1/10 of what I started out with, because it's been chipped away a little bit at a time and you hardly noticed a bit, that like boiling frog example. But if there's very little likelihood in your view of capital growth, and certainly the old thing of what goes up must come down, if we are expecting possibly a downward price correction, and a lot of recently occurring events on the world stage could trigger it. It could be the event. It could be all the sort of landlord bashing that George Osborne and his successors did, which wouldn't only bash landlords. First of all, it would affect tenants with higher rents, but more importantly for property owners, it would reduce the demand for property, so that prices would ultimately decline there. Then you've had your 1.5% return all for nothing. So then, looking at cash flow, and there's this line that extends, if I remember correctly, from Bristol on the one side to Hull on the other, and above that line, cash flow. If you're looking for cash flow, that's the place. That's the place to find it. So I think you might be well advised to look a bit further north in the country in order to make sure that you have a sustainable, profitable, ongoing business. And in terms of, we don't necessarily need to calculate the internal rate of return for 10 years from our business, but we can look forward and we can plan for the future in terms of a cash flow type business where you've bought the asset for this much. Any growth is a sort of bonus, you're not expecting it, and the cash flow you might get might be 8%, it might be 10%, it might be in some areas 15%. percent, and you've got to be careful of those because they might be the absolute dogs that are always going to be empty and have a crack den next door. But you know, to within reasonable norms, you can probably just touch on double figures, which if you're then using some kind of net cash flow reinvestment model to grow your business, and we'll come on to that one when we reach the letter N. It would be far too premature of me to speculate on such esoteric concepts today, especially since the walls of the Grand Canyon are looming ever closer here, and I feel a bit like that thing in Star Wars, you know, where they're navigating that, you know, that very famous flying scheme in the indeed sort of heart-stopping moment. But I think we have to always reevaluate what we do. Like dinosaurs, because something was working brilliantly 40 years ago doesn't mean it's the right strategy for today. And I do think we have to factor in the fact that property values, certainly in the south of England, have grown far faster than rents. And these values are locked in. There may well be some kind of tax payable when we realise them. We can't go down to Sainsbury's and other supermarkets are available to get the weekly shop on the basis of what it's worth. And yet cash coming in is something that's flexible, fluid. We can use it to reduce our mortgages. We can use it to buy more stock. We can use it to splash up on that once in a lifetime world cruise. So it has the flexibility to use it in any way we want. Whereas property, as we know, is a very illiquid asset. So if I suddenly needed to sell a house because my cash flow wasn't performing very well, that could take me 6 months, and that's not really acceptable.
Well, I tell you what. Between us, we've covered this week's episode. Wow, we've gone monthly. What a biog. But what's actually got me there is, you've just shown how long you've been investing. Pounds, shillings and pence.
That was it.
And you've got me. And buying houses for £27,500 in central London.
Yes.
You can't even buy a shoebox in London for that, let alone a garage, let alone the shed or the outside toilet. You've been investing too long, David. We need to get you out of here on the helicopter. Well, guys, we're going to see you next week. It's going to be good fun. Hopefully we land safely on the top over there. But it's been real good fun, this treat over the Grand Canyon. David, thanks. Awesome session again with you. And I hope everybody's learned something. Drop us some comments. Tell us what your favourite property strategy is so far in the box below. Because if you tell us what your favourites are, we might deep dive into them and give you a lot more information. Look forward to seeing you very soon. Thank you, everyone. David, thank you.
Yes. A pleasure as always, and looking very much forward to next. I wonder where we'll be next week. Whoa.
Where would you like us to go and visit on our holidays? Yeah, lockdown. Here we come. Goodbye, everyone.